Tensions continue to rise in global markets as economic indicators shift dramatically. The Federal Reserve faces mounting pressure while stocks fluctuate. From significant changes in the tech sector to rising consumer spending, these stories shape our world. Here are today's top 10 stories you need to know. Market analysts are closely monitoring various economic indicators as they gauge the health of the overall economy. Recent reports have highlighted fluctuations in key metrics such as unemployment rates, inflation, and consumer spending. These indicators play a crucial role in shaping economic policy decisions and investment strategies. Analysts are particularly focused on how these metrics will evolve in the coming months, especially in light of the Federal Reserve's recent statements regarding potential interest rate hikes. The implications of these indicators extend far beyond immediate market effects, influencing everything from corporate earnings to consumer behavior. As we enter the second half of the year, the attention to these economic signals will only intensify as businesses and investors seek to navigate an ever-changing landscape. The ongoing analysis of these indicators will be vital for making informed decisions moving forward. Initial public offerings, or IPOs, are continuing to show strength in the market despite broader economic uncertainties. Recent activity has included two Chinese semiconductor companies successfully raising approximately $1 billion in Hong Kong IPOs. This trend suggests that investor appetite for new offerings remains robust, even as other sectors face challenges. The success of these IPOs is a positive sign, indicating that certain industries are still attracting significant capital. As companies look to go public, market participants will be keenly observing how these offerings perform post-IPO. The resilience of the IPO market may serve as a barometer for investor confidence, and its continued strength could provide a much-needed boost to overall market sentiment. In the coming months, further IPO announcements are expected, which could contribute to market dynamics. Global economic forecasts are being adjusted as analysts reassess their predictions for growth in light of recent data. Recent inflation spikes, fueled by supply chain disruptions and geopolitical tensions, have raised concerns about the pace of recovery. Many economists are now projecting that the anticipated rebound may be slower than previously expected, particularly in developed economies like the United States and the Eurozone. This uncertainty surrounding inflation is influencing consumer behavior, leading to decreased spending and investment. Consequently, businesses and policymakers are urged to remain agile in their strategies, adapting to an unpredictable economic landscape. The adjustments in forecasts reflect a broader awareness of the interconnectedness of global markets and the potential for ripple effects. As we head into 2026, the ability to respond effectively to these evolving conditions will be essential for sustaining growth and stability. Policymakers must prioritize measures that address both inflation and economic resilience to foster a more robust recovery. Oil prices continue to exhibit volatility amid ongoing geopolitical tensions and economic uncertainties. A recent shaky truce between the U.S. and Iran has further intensified concerns, leading to fluctuations in global oil markets. This situation is compounded by broader issues, including the ongoing conflict in Ukraine and supply chain disruptions, which have created an unstable energy landscape. Traders are closely monitoring these developments, as any escalation could lead to significant disruptions in oil supplies, pushing prices higher. Analysts warn that the current geopolitical climate may create a precarious environment for oil prices, with sharp increases possible if tensions escalate. The energy sector remains on high alert, as rising oil prices could exacerbate inflationary pressures on consumers and businesses alike, potentially slowing economic growth. As oil remains a critical commodity for the global economy, stakeholders must remain vigilant. In the coming weeks, market participants will be particularly focused on diplomatic efforts and their potential effects on oil supply stability. Karyon Industries has announced the acquisition of industrial land and a factory for a total of $8.61 million. This strategic move is aimed at expanding its manufacturing capabilities and optimizing production processes. The acquisition comes at a time when the demand for industrial products is surging, driven by economic recovery and increased consumer spending. By enhancing its operational efficiency, Karyon Industries is positioning itself to meet this rising demand more effectively. The investment not only reflects the company's commitment to innovation, but also highlights a broader industry trend where companies are bolstering their operations in response to market fluctuations. Analysts suggest that this expansion could significantly improve Karyon's productivity levels and profit margins. As the company integrates its new assets, the anticipated increase in output may attract new clients and strengthen relationships with existing ones. Looking forward, Karyon Industries aims to leverage this expansion to solidify its market presence and explore new opportunities in emerging sectors. As the new month progresses, several major companies are preparing to release their earnings reports for the second quarter of 2026. Notably, Ares Capital Corporation has announced it will report its earnings on July 29th, providing critical insights into its financial performance. This announcement is particularly important for investors as it comes amid a fluctuating economic landscape marked by inflationary pressures and shifting consumer demand. Other companies, including Manpower Group, are also gearing up to unveil their quarterly results, which will shed light on employment trends and workforce dynamics. Earnings reports serve as vital indicators of a company's health and can significantly influence stock prices and investor sentiment. Market analysts will closely scrutinize these reports for signs of growth, operational efficiency, or potential challenges ahead. Companies that exceed earnings expectations may experience stock price surges, while those that miss projections could face declines. Investors will be keenly observing these earnings announcements, which could set the tone for market performance in the latter half of the year, especially in sectors sensitive to economic changes. In an encouraging sign for the economy, consumer spending has increased to a 3-year high, rising by 0.7% last month. This surge in spending comes despite a backdrop of rising inflation, which has reached its fastest pace in recent years. The Personal Consumption Expenditures Index reflects a 4.1% increase on an annual basis, indicating that consumers are still willing to spend despite economic pressures. This resilience is noteworthy, as it suggests that consumer confidence remains relatively strong despite fears of inflation. However, this raises questions about how long consumers can sustain this level of spending in the face of rising prices. Economists will be analyzing forthcoming consumer spending data closely, as it plays a crucial role in shaping economic growth. If this trend continues, it could influence Federal Reserve policies moving forward, particularly regarding interest rates and inflation management. Therefore, businesses and policymakers alike are keeping a close watch on consumer behavior as we advance into the second half of the year. Comcast shares have surged dramatically after the company announced its plan to split its operations into 2 separate entities. This strategic move is intended to streamline operations and enhance shareholder value. The first entity will focus on broadband and cable services, while the second will concentrate on media and entertainment. Following the announcement, Comcast stock rose significantly, indicating positive investor sentiment towards the decision. Market analysts view this split as a potential catalyst for growth, allowing each entity to focus on its core business without the complexities of a larger corporate structure. Investors are optimistic about the future of both companies, as they anticipate that the split will lead to increased efficiency and profitability. The timing of this announcement comes amid a challenging landscape for media and telecommunications companies, which have been grappling with rising competition and changing consumer habits. As the market reacts, the success of this split will hinge on the ability of each new entity to innovate and adapt. In the coming months, Comcast's leadership will need to demonstrate strategic agility to capitalize on emerging opportunities in their respective markets. Tech stocks have shown signs of recovery following a tumultuous previous week, which saw major indexes, including the Nasdaq, suffer significant losses. The Nasdaq Composite climbed 1.2%, driven by a strong performance from several tech giants. Notably, shares of Amazon surged over 5%, while Google's parent company Alphabet enjoyed a notable rise of 4% after being added to the Dow Jones. This rebound is significant, as it reflects investor confidence returning to the tech sector, suggesting that the overall market may be stabilizing despite ongoing volatility. The tech sector has faced challenges due to inflation concerns and rising interest rates, which have historically pressured growth stocks. Many investors had been cautious, fearing that higher borrowing costs could dampen consumer spending and corporate profits. However, this recent uptick indicates a potential shift in sentiment, with investors possibly viewing tech companies as resilient amid economic headwinds. The ongoing recovery could signal a turning point for investors who have faced a challenging environment in the first half of the year. Analysts predict that if these gains sustain, it may encourage further investment in technology, fueling innovation and growth. The next few weeks will be crucial in determining whether this momentum can translate into long-term stability. The Federal Reserve is grappling with significant economic uncertainty as inflation forecasts have dramatically shifted. Just 6 months ago, many policymakers anticipated inflation would stabilize at around 2.4%. However, recent projections now estimate inflation could rise to 3.6% by the end of the year. This unexpected twist has left financial experts and businesses scrambling to adjust their economic strategies. The 2-year Treasury yield has also risen sharply, reflecting market expectations that inflation pressures will persist longer than initially thought. As consumer spending remains robust, increasing by 0.7% last month, the Fed faces the dilemma of whether to raise interest rates to combat rising inflation. Traders are predicting an 80% chance of at least a quarter-point increase by year-end. This situation poses a complex challenge for the Fed, as they must balance economic growth with inflation control. Historical data suggests that prolonged inflation can erode purchasing power and destabilize markets, impacting everything from consumer confidence to investment decisions. The Fed's actions will directly influence borrowing costs for businesses and consumers alike. As we look to the future, the decisions made by the Fed in the coming months will not only shape the trajectory of the U.S. economy, but also set the tone for global financial markets, highlighting the critical importance of their upcoming meetings and policy announcements. Thank you for joining us today. Which story shocked you the most? Let us know in the comments, and don't forget to like and subscribe for more updates.